Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, shall we start? Yeah? All right. So welcome to week 5. And as you all know, the assignment is due next week, okay? So the assignment submission link is already open on Wattle, okay? So if you have already finished, you're more than welcome to submit, okay? But otherwise, the deadline is 4 p.m. next Thursday, okay? So in terms of the content of the assignment, right? So I mentioned this last week. This week's material is particularly useful for your assignment, okay? So we're going to talk about earnings management today. And I recall for your assignment, you need to, well, at least for part B, you need to list at least six motivations for earnings management, okay, or even more. So we'll talk about 3 in details today, and then I will mention briefly on the other 2 motivations, but there are tons of other motivations in the literature, okay? So you should be able to search and find those articles talk about other incentives. So I'll come back to this point a bit later, okay? But today's topic is on earnings management, which is very relevant for your assignment. Okay, so the submission is already open, as I mentioned. If you go to Wattle, okay, under the assessment block, you should be able to see the turn it in site for assignment part A, okay? So if you click in, you should be able to see the due date, which is 4 p.m. Next Thursday, okay? And you should be able to click, I think you should be able to click here and then make your submission, okay? Now, what I highlighted here is you don't actually need to provide a assignment cover sheet that you normally would do for other assignments, you know, in the past. But to save your time, you don't actually need to attach this cover sheet, okay? But each page of your assignment must contain the unique ID and name of each student in the group and the name of your tutor, okay? Either in the header or in the footer, okay? So every group only need to make 1 submission, okay? So don't make multiple submissions. If you make multiple, we will only mark 1, okay? We'll mark the latest one. Now, I know some of you are quite last minute, okay? Myself is last minute, but because you are submitting your assignment online, therefore you have to consider the glitch of the website, okay? So it happened in the past that lots of students try to submit right before 4 p.m., the due date. And the system takes time to process, okay? Large volume of submissions. So if you are submitting close to the due date and you don't see your submission appear, okay? It's because the system might take time to process, okay? So if that happens, don't be panic, okay? So just send me an email together with your submission before 4 p.m. and then I will consider your submission is still on time, even though the system requires submission after the submission day, okay? So what I'm saying here is late submissions on turning in are allowed, okay? But will occur penalties. So if you submit, let's say, 24 hours late and without a legitimate reason, then we will put penalties on your submission. Making sense? Yeah? Okay. So that's about the assignment. Now, has anyone started? Is there any questions about the assignment so far? Okay, so I assume everyone's okay with the assignment so far? Or you haven't started? anyway. If you have questions, you can ask me, okay, by email. Right, so let's quickly have a revision of what we did last week, okay? Because what we did last week lays the foundation for this week's material. So we talk about accounting theory, right? So last week we focused on the positive accounting theory, and we talk about the underlying assumptions of positive accounting theory, which is grounded in agency theory, right? So remember agency theory? We talk about the agency relationships, right? So we explore two key issues, or two agency relationships. So we talk about shareholders-manager relationship. We also talk about shareholder or manager debt holder relationship. Okay, so they apply to different type of agency issue and agency costs. Okay, so we're going to talk about these two relationships a bit more today when we talk about those different hypotheses. Okay. So what we're going to do today, we're going to talk about those original positive accounting theory hypotheses. Okay, so there are three hypotheses that we're going to talk about today, and these three hypotheses are linked to the manager's incentive to manage earnings. Okay, so what I'm saying earlier is that I will talk about these three motivations or three hypotheses in more details in lecture, and then I'll quickly go through the other two, and you'll have a tutorial question on the other two motivations, and then you only need to search one or two additional motivations from the literature to satisfy the requirement of assignment. Okay, so the assignment is not difficult. Okay, because I will talk about most of the issues already. So the three hypotheses that we're going to have a close look today: bonus plan hypothesis, okay, debt hypothesis, and then the political cost hypothesis. Okay, so these three hypotheses talks about three different incentives or motivations for manager to manipulate earnings. Okay, and then at the end of the lecture, we're going to talk about how do we detect earnings management. Okay, from the research perspective. Okay, so let's quickly review the underlying assumption for positive accounting theory, okay, because this is very important, and later on when you see our discussion, it's actually grounded by this assumption. So last week we said the underlying assumption is that everybody is driven by their self-interest, right? So individuals' action is driven by the self-interest, and individuals may act in an opportunistic manner to the extent that actions will increase their wealth. Okay, so we need to be aware of this situation. Okay, so a lot of time when your interests and my interests are aligned, we don't have this agency problem. Okay, because we are working towards the common goal. So we don't need to worry about the self-interest when the interests are aligned. Okay, but when our interests are in conflict, okay, so this is where the problem comes, right? So if our interests are in conflict, then both parties, right, would assume or at least need to be aware that the counterparty may may act opportunistically to pursue their own self-interest. Okay, so just remember that. And then agency theory demonstrated that the management of corporations are sometimes have incentive to act contrary to shareholders or debt holders' best interest. So we talk about that, right? So what is agency theory? Agency theory talk about the relationship between the agents and the principal. It happens when the principal delegates decision rights to the agent so that the agent can act on behalf of the principal, right? But this relationship have problem because the two parties are driven by self-interest, okay? And when the agent interest is in conflict of the principal's interest, then we have this agency problem, okay? And then we talk about two mechanisms that companies or the shareholders put in place to reduce these agency issues. Making sense? Yeah, so we talk about the bonding mechanisms, we talk about those monitoring mechanisms, yeah? Okay, so what we have today, okay, is three key hypotheses frequently used in the literature to explain and predict the economic behavior of accountants when we talk about accountants, basically they are managers, okay? So the three hypotheses, bonus plan hypothesis, looks into the relationship between shareholders and managers, okay? The debt hypothesis looks into the relationship between shareholders and the debt holders, okay? And then the political cost hypothesis looks into the relationship between shareholders and the regulatory body or the politicians. Okay, so we'll talk about that in a minute. So before we go to the three hypotheses in more details, okay, our topic today is on earnings management, right? So first of all, what is earnings management? Remember that for part A of your assignment, you need to define the key terms, right? And I guess everybody will need to define earnings management. Okay, so what is it? So earnings management, first of all, is not illegal. Okay, so earnings management does not include outright fabrication of transactions. Okay, but it does include abuses of the discretionary judgment used in estimating items, such as the allowance for doubtful debt, provisions, revenue recognition, and depreciation expense, and all other items that involves professional judgment. Okay, so if you fabricate transactions, okay, so for example, you create fictitious customer and you make sales to this fictitious customer, it means it's not earnings management, okay, it's fraud, okay, so fabrication of transactions is illegal, okay, and it's not earnings management. So what is earnings management? Earnings management include abuses of discretionary judgment used in accounting estimates. Okay, now we are accountants, right? So we talk about accounting estimates all the time. So I think by now you should be very familiar with allowance for doubtful debt, provisions, or depreciation, because we keep talking about these items, right? Start from week 1. So these items involve judgment, and there's nothing wrong with the judgment. Okay, so earnings management is not good only when the managers abuses the power when they are making this judgment. Making sense? Yeah? So therefore, how do we actually define earnings management? Now, if you go to different accounting research about earnings management, you might see all other kind of definitions. Okay, so in our course, we pick the definition from Healy and Whalen in 1999. Okay, so why we pick this definition? Because it actually includes the means of earnings management and also the purpose of earnings management. Okay, so how they define it? So they say earnings management occurs when managers use judgment in financial reporting and in structuring transactions, okay, to alter financial reports. So you can see the first two terms I highlighted in red, they are the means to earnings management. Okay, so in other words, if the managers decide to use judgment, decide to manage the earnings, there are two ways they can do it. First of all, they can manage the accounting records. Okay, so this is the first one, financial reporting. Okay, they use judgment in financial reporting, so they manage the accounting records. They manage the accruals. Okay, so we're going to talk about accruals later on. Okay, so how do they do it, right? So they can make a very aggressive judgment on, let's say, credit sales, right? So for example, the managers can increase the sales volume, the credit sales volume, okay, to a large customer base than they used to have, okay, without checking the customer's credit ratings, okay? Now, is there anything wrong with it? Is it illegal? It's not illegal, right? Because you can actually make sales to your customers, okay? But if you make sales to those customers which potentially cannot pay you back, right? Then you are actually inflating your sales revenue and you're inflating your accounts receivable at the time when you make the sales. Making sense? Yeah? So this is one example about the first way, okay? You manage the accounting records. Now, the second way to manage earnings is to manage the transactions. Okay, so manage the real transactions. So how do you do it? So for example, the managers can decide when to purchase inventory, right? They can decide when to delay the purchase of inventory. They can decide when to sell the inventory and when not to sell inventory. Okay, so why they make different judgment? Because they may have different incentives, right? So for example, if they want to boost the ending inventory balance to create a more positive figure for assets at the end of year, what they can do, they can delay the sale of inventory, yeah? Or they can have a very big volume purchase of inventory just at the end of the year, right? So this refers to the second way to manage earnings, right? You manage the real transactions, okay? So what's the purpose? The purpose for earnings management is to alter financial reports to either mislead some stakeholders about the underlying economic performance of the company or to influence contractual outcomes that depend on reported accounting numbers, okay? So two purposes here. The first purpose, we want to mislead some stakeholders about the underlying economic performance of the company, okay? So we want to manage the perceptions of the users of financial statement in terms of how well the company perform, okay? So you can manage the earnings downward or upward, all right? So you want to manipulate the user's perception, okay? Or you want to influence the contractual outcomes that depend on the reported accounting numbers, okay? So last week we talked about lots of contracts, right, within a firm. So you might have a contract, that contract with your creditors, right? You may also have a contract with your board of directors about your compensation, right? And a lot of time we use accounting numbers. So in these contracts, for example, we use in the debt covenants, we have different accounting ratios, right? And in the compensation schemes, we have performance target, normally expressed as a share price or, the reported earnings, okay? So managers can manage the earnings to influence the contractual outcomes because they have the power to influence the accounting data. Making sense? So they manage the numbers to influence the contractual outcomes in the way that they like. Making sense? Yeah? So these are the two purposes. Okay, so now we talk about two ways, right, to manage earnings. And these two ways basically refers to two distinct types of earnings management, okay? So the first type, okay, is to bias the judgment in reporting decision, okay? So we are talking about the first way to manage earnings. We use discretionary judgment in financial reporting. So we want to bias the judgment in reporting decisions, okay? So this refers to the deliberately high under or overestimating accruals, such as depreciation, okay? So if you have a computer was $1,000, okay, and the useful life, you think the useful life is 10 years, so every year you would depreciate your computer for $100, but I don't like my current earning. I think my expense is too high, so what I can do is I can actually abuse my judgment, right, about the useful life. So I say the useful life of my computer is 100 years, okay? So every year I'll only depreciate $10. Making sense? So this is an example of deliberately under or overestimate accruals, such as depreciation. Okay. Another example, which we used earlier, is to make credit sales to customer. Okay. So you can boost the customer base by increasing the credit sales volume. Okay. But deep down, sometime in future, some of these customers will never be able to pay you. Okay. But at least for the current year, your sales revenue looks good and your accounts receivable looks good. Okay. So that's the first type of earnings management. Now we manage the accounting records. So what kind of accounting records can be managed? These are the accruals that can be managed. Okay, so I'll talk about accruals in a minute, but for now, what we need to know is the first type actually refers to as accrual-based earnings management. So accrual-based, what are accruals? Accruals are those accounts that does not involve cash, right? So you've learned that from your first accounting course. Yeah? Okay. We'll come back to that in a minute, okay? Now, the second type of earnings management is to alter the timing of the actual business transactions, okay? So we are talking about the second way to manage earnings. We try to manage the transactions, okay? So what's the common way for us to do it? We can alter the timing of the actual business transactions. So for example, we can shift the reported earnings from one period to another, okay? So we can purchase large quantity of inventory just before the year end to boost our year-end inventory balance, inventory number, okay? Or if you are a manufacturer, right, you can, and you have the capacity, you can overproduce your inventory. So when you overproduce your inventory, you are actually allocating, you are spreading overheads to a large base, so you are reducing your cost of sales. Making sense? So there are different ways, okay, to manage the actual transactions. For, let's say, for a research-intensive firm, you can actually delay your investment in a research activity, so you can avoid a huge development expense sitting on your year-end income statement, okay? Multiple ways, and for this type of earnings management, we call them real earnings management, okay? Because we're managing the real transaction. Happy about this? Yeah? So the literatures, okay, the accounting literatures, both type of earnings management are quite rich, okay? But in our course today, we are going to focus on the accrual-based earnings management. But remember, the motivation behind earnings management, these two types of earnings management are the same. It's just we do it differently, okay? So our focus is on accrual-based earnings management, okay? Now, we mentioned earlier, right, earnings management is not illegal. So what is illegal? Fraud is illegal, right? So some of you might have read some articles about accounting fraud, okay? So accounting fraud is a different concept, okay? Because fraud involves the intention to deceive others, okay? And for earnings management, it's very hard for us to prove that accountants deliberately or have the intention to deceive the user, to mislead the users, okay? So for earnings management, we really cannot establish this intention. Therefore, it's not equivalent to fraud. Making sense? Yeah? Okay. And also in the literature, you might see the term called earnings manipulation. Okay? Now, in the old days, earnings manipulation and earnings management are used interchangeably. Okay? But if you look at the word, right, the meaning of the word management and manipulation, the meaning is different. Manipulation involves intention. Yeah? Because you have this intention to manipulate the accounts, okay? Whereas management does not involve what? It's hard to say it involves intention, okay? So you need to distinguish between earnings management from earnings manipulation as well, okay? They're not quite the same thing. Okay, so what is the intended effect of earnings management? Okay, now in different circumstances, managers may wish to increase reported income. Okay, if they want to boost the share price, they can manage the reported income upward. Okay, or in other times, in other circumstances, they want to decrease the reported income. Okay, and we'll talk about those scenarios in a minute. Okay, so in what kind of circumstances the managers may have incentive to decrease the reported income. And then in other circumstances, the managers want to reduce the volatility of reported income across time. Okay, so for the third type, we call this third effect. We call this income smoothing. Okay, so by name, smoothing. You want to smooth the income. You want to make your income more stable, right? Appear to be more stable across time. Okay, why do we do that? Because users normally do not like volatility. So you have done some of your finance courses, right? We don't like volatility. Volatility means risk. Risk means costs. Okay, so users tend to avoid volatile markets, or if the market is quite volatile, it will deter users' investment. okay, investment. So for example, if we look at the housing market these days, right, and we know the housing price is dropping, okay, if you have enough money and you actually want to invest in the market, okay, and you see a property which was advertised for 2 million a month ago, and now it's 1.8 million, and there's still nobody purchasing this property. And why? Because users, even though they have money, they want to wait and see if the price will be dropped further, right? So volatility deters investment, okay? So it creates incentive for the manager, right, to smooth the earning, to report a more stable earnings, because stable means predictable, right? So users can predict what will happen in future according to the previous pattern. Okay, happy about that? So these are the intended effects of earnings management, either upward or downward, or you want to smooth it, okay? Now, this is very important, okay? So this is probably one of the most important sentence in today's lecture notes, okay? So our focus today is the accrual-based earnings management, right? And in theory, okay, we're talking about theory. In theory, all accruals reverse eventually, okay? So that it should not be possible to permanently overstate or understate earnings, but this is in theory, okay? So first of all, what is accruals? Our accounting is, we are using accrual-based accounting, right? So what does that mean? Anyone? No idea? So what are some examples of accruals? Depreciation, yes, that's good. Anything else? So when we talk about accruals, right, and you look at the items on your income statement, right, because we're interested in the reported earnings, reported profit, okay? So how do we recognize revenue? Revenues are recognized when they're incurred, right? And is cash relevant here? Cash is not relevant, right? So if we have a cash sale, okay, we increase cash, we debit cash, and we credit sales revenue. So that is a cash transaction, okay? It's not accruals, okay? But if we make credit sales, okay, and the credit sales will give you accruals. Why? Because you haven't received any cash yet, okay? So on the day when you recognize revenue, you will increase your accounts receivable and you increase your sales revenue. And this sales revenue is a credit sales revenue, and this is your accrual, okay? So we recognize revenue. It doesn't matter whether it's cash revenue or it's a credit revenue. We recognize revenue anyway on our income statement as long as this transaction already take place. Making sense? Similarly, when we recognize expense, okay, we don't really care whether we incur cash outflow or not. We recognize expense anyway, okay, when they're incurred. Making sense? So for example, depreciation, right? Depreciation expense does not involve cash, therefore it's our accruals. Happy about that? Now, what we are saying here is these accruals, all accruals, they will reverse eventually in future, okay? So if we look at accounts receivable as an example, okay? Today, when you make credit sales to your customer, let's say the sales term is 30 days, okay? Even though you do not receive cash immediately, right? But you will receive cash from your customer in 30 days, okay? So you recognize accounts receivable in day 1 when you make the sale, but in day 30, when the customer pay you back, you need to write off your accounts receivable and you increase cash. Making sense? So then the accounts receivable you recognized earlier reversed after 30 days. Making sense? So this is when you receive the payment from your customer. What if the customer cannot pay you in 30 days? You have to write off your accounts receivable and you need to recognize a bad debt expense. But anyhow, your accounts receivable is reversed. Making sense? Yeah? So accounts receivable is an example. The other example is depreciation expense. Okay? So when you purchase a PPE, what you do, you increase PPE, you debit PPE, and you credit cash, right? Because you might use cash to pay your PPE. So the PPE is sitting on your balance sheet, and this is a positive accrual, okay? But when you start to use this PPE, the economic benefit that PPE brings to you will then be deducted from the original cost from the PPE, right? That's why every year, when you are using this PPE, you incur depreciation expense. So the total value of the assets of PPE that you recognized earlier gradually reverse back to depreciation expense. So at the end of the day, at the end of the useful life, your PPE will become zero. Making sense? After deducting the depreciation expense across the useful life. So your PPE, as you can see, again, reversed, okay, in the form of depreciation expense. So all the accruals will reverse eventually, okay, in theory, okay? So therefore, it doesn't matter, whether you are overstating or understating your accruals for one period, because in the next period, it will reverse back, okay? So if you have a lot of accounts receivable today, you manage your accounts receivable, you manage your credit sales today, okay, upwards, but then you'll bear the cost in future because some of the customer may not be able to pay you. You have to write off these accounts payable. So if you have high positive accruals in this period, and you will expect negative accruals in future. If you have a large amount of negative accruals today, in future, you will expect these negative accruals will reverse back to positive in future. Making sense? Yep. So this is very important, okay? Accruals will reverse eventually. But what we talk about is in theory, right? They will reverse, but in practice, okay, there are numerous breaches of this idea, okay? So we call this clean surplus relation in accounting. So what is clean surplus? Clean surplus means, in theory, okay, all the gains or losses should go through income statement, okay? So all the accruals should reverse in future, okay? But in practice, there are numerous breaches which allow firm to take decisions which permanently reduce reported income, okay? So now we understand what is accrual, and then we understand what is earnings management, okay? So now let's have a look at the first hypothesis, the first motivation for managers to manage earnings, okay? So the first hypothesis we are looking at is this bonus plan hypothesis, okay? So we talked about bonus plan a little bit last week, right? So when we say to reduce the agency cost, right, as a result from the shareholder and the manager relationship, what we can do is we can have this bonding mechanism to align the manager's interest with the shareholder's interest. Remember that? Yeah? So we talk about three ways, right? Three mechanisms for bonding. We can give them bonus, we can give them ordinary shares, or we can give them options, right? So we talk about granting shares and granting options last week. So today let's have a look at the bonus, okay? Why we talk about this? Because bonus was very popular in the old days, in 90s and 80s, okay? And it's still in use nowadays, even though it's not in fashion, but some companies are still using these bonus schemes, okay? So it's still relevant today. So we use this idea from Healy's 1985, okay? So what Healy does is he studied the behavior of income increasing and decreasing accruals with respect to the terms of manager's bonus scheme, okay? So he actually want to study whether the terms of manager's bonus scheme will lead to earnings management behavior, okay? But earnings management behavior are very hard to observe, right? You can actually you actually can't see whether the company have earnings management behavior because the managers will never tell you that they manage earnings downward or upward, right? So what they do is they look at income increasing accruals and income decreasing accruals as proxies for earnings management, okay? So the bonus schemes are used as an attempt to align the manager's interests with those of shareholders. Okay? So what is a bonus scheme? Bonus schemes usually pay a bonus to manager only when the firm's reported profit falls within a certain range. Okay? So let me give you an example. Okay? So let's say for the managers to obtain a bonus, okay, in this particular company, the company's reported profit should fall within this range. So the lower bound, okay, normally because we're talking about a certain range, right? So the bottom line is that this company's earnings per share should hit $1.10. So this is a lower bound, okay? And the upper bound is earnings per share of $1.50, okay? So in the old days, okay, normally when we give bonus, okay, the manager obtain bonus if the profit falls in within this range, okay? So if the reported earnings, okay, hits the lower bound, the manager will get the bonus. However, if the reported earnings is above the upper bound, normally the manager will not get extra bonus. Making sense? So for every dollar of income within this range, okay, managers get a paid percentage bonus. So that's an example of bonus schemes, okay? And then what Healy does is to see in what scenario the managers will manage the earnings downward and in what scenario manager will manage the earnings upward. Okay, so there are 3 scenarios. The first scenarios, okay? So what if your earnings, the reported earnings, is just below the target, just below the lower bound? Let's say the EPS is $1, so it's only 10 cents below the lower bound. So from Healy's test, right, Healy actually found if the earnings is just below the lower bound of the bonus range, okay, managers will manage the earnings upward. Does that make sense to you? Because it's so close to hit the target. If you manage the earnings upward, you get a bonus. Making sense? So the bonus creates a strong incentive for the managers to increase accruals, to manage the earnings upward, okay? Now, if the earnings is way below the lower bound, so let's say the EPS is 70 cents, okay? Healy found managers in this scenario, they tend to manage the earnings downward instead of upward. And why is that? Is there any guess? Yes. So if we look at the second scenario here, right? If your reported earnings is way below the lower bound, it takes you a lot of effort to manage the earnings upward. Okay? So we all know, right? So when we manage the earnings, we manage the accruals. And these managers know accruals eventually will reverse. Right? So if it's so hard for you to manage the earnings upward, these managers will manage earnings downward, so they will have a big negative accruals in this year and hoping these negative accruals will reverse back in future. And then they can utilize this portion in future to hit future's performance target. Does that make sense? Yeah? So we call this behavior as taking a bath, okay? So you manage your accruals downward, manage your earnings downward, okay? For this. So these are the 2 scenarios already. The third scenario, okay? What if your earnings is above the upper bound, okay? If your earnings is above upper bound, you don't receive extra bonus. So what do? Healy found that managers tend to manage the earnings downward as well, for the same reason as the second scenario here, okay? You've already getting your bonus, and by doing better, you don't get extra, okay? So what do? You manage the earnings downward, so you write off some accruals and hoping these negative accruals will reverse back in future, so you can benefit from this in future. Making sense? Yeah? So this is what Healy's found, okay? So that's the incentive, okay? Bonus incentive hypothesis, okay, to manipulate accruals. So we've already talked about this. When the managers perceive that the current year's income is well below the lower bound, he or she may attempt to take a bath, okay, by processing income decreasing accruals. And it's actually a lot easier for you to decrease accruals than increase accruals, right? Why? Because conservatism, right? So we tend to, so we only need you to exercise caution when you are valuing your assets and income upwards, but you don't actually need to be so careful when you try to inflate your expenses or liabilities, right? We talk about in week 3, the prudence or the conservative principle, right? So it's a lot easier for the manager to process income decreasing accruals. So for example, you can actually make a very pessimistic estimation of your allowance for doubtful debt, or you can increase your depreciation expense by decreasing the useful life of your asset, right? So it's very easy to do it. So what do they hope? They hope that these accruals will be reversed in future, okay? When the company's income is within the bonus range, earning the manager a larger bonus check in the future, okay? Making sense? All right. And then Healy also found the managers tend to take a bath to have higher income decreasing accruals than average firm, okay? So now, what Healy has found, the 3 scenarios, right? His results support his bonus plan scheme, bonus plan hypothesis, okay? But it does not prove that the existence of earnings management. Does that make sense? So we said in week 2, a theory can never be proved, right? Because we don't have enough observation to say that, okay? So what we can say is it is simply consistent with earnings management behavior, because we cannot directly observe earnings management behavior, but then we make predictions. When we see income increasing accruals and income decreasing accruals, very likely the company managed their earnings. Making sense? So it's just a methodological way of saying things, okay? So in your previous study or in those papers that you've read, okay, you probably see the discussion of necessary and sufficient conditions for a particular result, okay? So the example I'm giving you here is, if you consider this, right? You can't make an omelette without breaking eggs. Breaking egg is a necessary but not sufficient condition for making omelette, right? Just because you break an egg, it doesn't mean that you have made an omelette. But what you can say is, because you break an egg, I predict you are about to make an omelette. Okay? So the same thing applies to Healy's results. Okay? Because I see your income, your accruals increase, okay? Or I see your accruals decrease. So I predict you manage the earnings. You have earnings management behavior. Does that make sense? Yeah? So it's not a necessary, it's not a sufficient condition for earnings management to occur, but it's necessary, okay? Now, we talk about the managers may have incentive to decrease, to manage the earnings downward, right? When they are well below the performance target or they are above the performance, the upper bound, right? For the bonus range, okay? So when they manage these accruals downward, we'll have negative accruals, okay? But if you talk to your friends about Healy's results, okay, you see, when the company have these negative accruals, the managers are managing the earnings. Okay, so if you talk to your friends about this result, and your friends probably are doing, let's say, the first accounting unit. Okay, so they may then come back to you. No, I don't believe you. I don't think this is the only reason for the company to have negative accruals, right? Because there are so many other explanations that that can explain why a company will have negative accruals, right? So for example, negative accruals tend to be high in bad years, okay? Your allowance for doubtful debt might be very high in recessions. Why? Because simply the industry is not doing well, so lots of your customers are not able to pay you back, okay? So it's the normal business cycle, it's the normal business conditions, okay? So it's an industry-wide problem, then the negative accruals in bad years can be explained by this, okay? It doesn't mean managers deliberately manage the earnings downward. Does that make sense, right? So there are alternative explanations for Healy's results, okay? So nowadays, as researchers, right, you see those accounting papers, there are a lot of tests, a lot of tables. So researchers do a lot of tests. Why they do that? Because they want to rule out these alternative explanations, okay? So the second paper, Lacker and Sloan, okay, 1995, they retest Healy's hypothesis. So Healy's hypothesis was in 1985. 10 years later, Lacker and Sloan, they retested Healy's hypothesis, okay? But they refined the measures, okay, of earnings management. They refined the measures of the bonus contracts. So they actually use the actual terms of managers' bonus contract, and they have a more robust method of detecting earnings management, okay? What they found? They found no significant evidence of the big bars in years when the earnings are below the lower bound, but they do find significant evidence of downward earnings management in years when the upper bound succeeded. Okay, so in other words, what's the name again? Sloan, right? 1995, that paper only find evidence to support this bit, but they do not find evidence to support this bit, okay? When they refined the measures. So that was in 1985 and 1995, right? People start to realize that if you give bonus contract to the managers will have incentive to either manage the earnings downward or upward depending on different scenarios. Yes? So then the market will actually respond to it, right? So the firms start to realize this problem. So then they have shifted emphasis towards granting managers shares and options, okay? Rather than relying on accounting-based contracts to provide appropriate incentives, okay? Because the bonus plan hypothesis tells us that managers have a strong incentive to manage earnings, okay? To obtain bonus, because the bonus scheme is set in a way that is based on accounting accruals, accounting numbers, okay? So it's very easy for the managers to manipulate it, okay? For their own interest. So then the firm said, okay, we are going to shift our focus, okay, in executive pay from the bonus plan to the ordinary shares or to give them options. Okay, why? Because when you grant managers shares and when you grant managers options, you are not looking at short-term period. You are looking at a longer period of the company's performance. And the fact that when you give them shares and options, you are aligning managers' interest with the shareholders a bit better because you are using share price as your measurement. Yes? But then, of course, as you all know, these two mechanisms, right, given the manager's shares or options, also create a new form of agency problem, and we've already discussed that last week. Yeah? Why? Even though the contract is tied with the share price, but we're going to talk about this a bit more next week, right? The share price reacts to reported earnings. So the market actually responds to reported earnings, and managers, once again, they have influence over reported earnings, okay? So even though you are giving them shares or options, simply because the share price reacts to reported earnings, therefore it creates other incentive problems, okay? So that's the first hypothesis, all good? Okay, let's talk about the second hypothesis, okay? The second hypothesis talks about the relationship between shareholders and debt agency problem, and this is the debt hypothesis, okay? So let's just have a very quick revision because some of these issues we've already discussed, okay? So when you lend money to a company, right, to a firm, okay, the firms with significant amounts of debt may have an incentive to invest in riskier projects than zero-debt firms because the lender is bearing some of the downside risk of the project, right? So the example I gave you last week is you can lend me $1 million, I can take your money, go to casino, right? I can take your money to invest in risky projects. Why? Because if I win, I will only give you the agreed principal and interest back. I enjoy the rest of the benefit. But if I lose, you bear the cost, right? Because I'm not able to pay you back, so you lose everything that you lent to me. So the debt holder's interest is not aligned with the firm's interest in this relationship, right? Because as a firm, the borrowing actually increases your risk appetite. Okay, so you are more likely to invest in the risky projects. Okay, so to mitigate this effect, we talked about this right last week. Lenders insist on restrictive covenants in the debt contract. So they want to restrict the firm's risky behavior. How do they do that? They incorporate accounting ratios in the restrictive covenants, right, in the contract. So, for example, they use the DE ratios. They maximize. They use the dividend payout, and they use the interest coverage ratios to limit this risky behavior by firms. Okay, but once again, these measures, they are using accounting data, right? And the managers have a power to influence this data. They have the power to manage this data. Okay. So why the managers manage earnings? Okay, so now we talk about this incentive. Because the firm, they do not want to breach the debt covenant. Why? Because the breach of debt covenant is a technical default on the loan. It creates huge costs for the company. Making sense? Yeah? So think about, right, if you breach the debt covenant. So what's the consequence? The creditors, the bank, may ask for immediate repayment. Okay? If you don't have enough cash flows, you don't have enough cash on hand, you are unable to make the repayment immediately, you default. Yes? Or the second option, the bank says, okay, you breach the debt covenant, I allow you to negotiate your contract with me. Okay? So the firm then given the option to renegotiate the debt contract with the bank, but guess what? The bank is going to have a more restrictive debt covenant in the negotiated contract. They will also increase the cost of borrowing, just to make sure that you don't breach the debt covenant again. And they penalize you for the breach of the first covenant by increase the cost of borrowing, so charge you a higher interest. Okay? So it doesn't matter which option the creditor gave you. Okay? So if they ask for immediate repayment, you default if you don't have enough cash on hand, or they renegotiate the contract with you, but the cost of borrowing increase. Okay? So it doesn't matter which option, the company incur a very high cost by breaching the debt covenant, right? Now the managers have the power to manage the earnings, right? So to avoid the breach of debt covenant, they manage the earnings. Making sense? So this gives the manager a very strong incentive, okay, to manage earnings because they do not want to breach the debt covenant. So this is the debt hypothesis. Happy about this? Yeah? So what I have here is the debt hypothesis from an early accounting paper, okay? So the higher a firm's debt to equity ratio, the more likely managers will adopt accounting methods to increase income or to smooth income. Okay? So now if you look at this hypothesis, right, this prediction, it used the firm's DE ratio, okay? But what do we really want to test in this debt hypothesis is how likely that the company is about, let me reword that. So what we really want to test in this hypothesis is that the closer to breach a debt covenant, the more likely that the manager will manage the earnings, right? So this is our original hypothesis. So our prediction based on our discussion earlier is the closer the company is about to breach the debt covenant, the more likely the manager will adopt accounting methods to increase income or to smooth income, right? So why don't we use that in the hypothesis? This is because this research was done 20 years ago, okay? And at that time, we do not have any data on the debt covenant, okay? So at that time, the researcher was unable to get information on debt covenant, and they had no idea whether the company was about to breach the debt covenant, okay? So they cannot observe how close that the company is about to breach the debt covenant. Therefore, they choose a very rough proxy, the DE ratio, to represent how close that the company is about to breach the debt covenant. Does that make sense? Yeah? At that time, we don't have enough data on debt covenant. Okay, so we choose a very rough proxy. Why? Because at that time, the balance sheet are already quite established. Okay, so the debt level or the equity level of a firm is observable, but the debt covenant itself is not observable. Okay, so we choose the DE ratio as a proxy. So this is our hypothesis. Okay, and then people test this hypothesis, and they found, okay, evidence consistent with the proposition, right? Managers manipulate earnings in the years prior to breaching accounting-based debt covenants. They actually found evidence to support that hypothesis, okay? Now, it's easy to understand why the managers are likely to manage the earnings upward to increase income, right? If they're about to breach the debt covenant. But why the managers may also want to smooth the income when they're about to breach the debt covenant. So then we have to talk about what is income smoothing, okay? So research actually found evidence that the existence of debt covenant can also induce income smoothing, okay? So what is income smoothing? We want to reduce the volatility of income across time, right? So it refers to the deliberate biasing of reported income to produce a smoother pattern of income across time. Okay? So this then involves artificially increased income in bad years and artificially decreasing income in good years. Okay? Now, if you have debt covenant, okay, in your borrowings, managers may have incentive to smooth the income so that your good years no longer look so good, and your bad years no longer look so bad, right? So you can actually use your earnings in the good years to offset against your loss in the bad years. Making sense? So that you do not breach the debt covenant. So that's the motivation behind income smoothing behavior if you have a debt covenant. Happy about this? Yeah? Okay. Now, how about we take 5 minutes break, because we do have a lot of things to cover. So when we come back, we'll talk about the third hypothesis, okay? let me have a look. Well, it didn't say, right? So you can actually use the motivations that I talk about in the lecture. So what we have here is identify at least 5 motivations for earnings management.
Yes.
Yeah, that's it.
Thank you.
Yeah, but you need to do your own research, right? So you need to search for at least 12 articles, right? Apart from the 2 over there, and apart from, oh no, yeah, you can actually use the article I give to you in the prescribed readings, yes, but I don't think there are 12, so you need to search more. But for the 5 motivations, right, it doesn't say that you cannot use the one I discussed in the lecture. Okay. Yeah. Okay, so let's start again. All right, now the third hypothesis, okay, is called political cost hypothesis, okay? So why? Because we believe political cost is another motivation for the manager to manage earnings, okay? And why is that? Because if you track political attention, okay, it will increase your cost. Why would I say that? Okay, so if you look at Qantas, right, in a few years ago, just 2 or 3 years ago, Qantas is making a huge profit, right? It's one of the most profitable company in Australia, right? So it attracts a lot of attention. A lot of its employees actually are protesting, and at that time you can see there's a lot of news about Qantas employee protest to fight for increased wage and a better work environment, something like that, okay? So large companies like this, they are more likely to attract political attention, okay? And there are costs attached to this political attention, so this may result in the increased tax, increased wage claim, and product boycotts, and all of these is something that managers want to avoid. Making sense? So the political attention is something that the manager wants to avoid, and therefore they will have a strong incentive to manage their earnings downward. Because if you are making huge profit, it makes you more visible, right, to the politicians or to the public. Okay? So for that, you want to avoid the political attention. You want to make your firm less visible to the politician, to the public. So you may adopt accounting methods to reduce the profit or to smooth the profit to lower the political scrutiny. Does that make sense? Yes? Okay. So what kind of firms are likely to be highly visible, right? So these are likely to be the large firms, those monopolies, okay, or other protected firms, such as Telstra in Australia, such as Qantas in Australia, such as Woolies and Coles, right, in Australia. So these companies are large, and they make huge profit. They are highly visible, okay, to the public and to the politicians. So the politicians, right, they know that highly profitable companies could be unpopular with the members in the community, okay? So, and they know that they can win votes by taking actions against the company like that, So they can argue that in public interest, even though it's in their own interest. So we just had our election year, right? So this is our election year, and before the election, you can see different parties, politicians, okay? They talk about their policies, okay? And quite often, politicians want to impose higher tax rate on large corporations, but on the other hand, they propose to reduce the tax for small or medium-sized company. Why do they want to do that? They want to win the votes, right? So they can argue these companies, they are making huge profit, they need to pay higher tax, therefore they give back to the community, okay? So what do? They increase the tax rate for these companies. And when you increase the tax rate, you impose costs to this company, okay? So these companies, therefore, have a strong incentive to avoid this from happening. Okay, so what they do, they then want to make their profit less attractable, less visible, so they reduce their income. Okay, so the political cost hypothesis basically says the more likely that you are attracting political attention, the more political attention you are attracting, the more likely that you are going to use accounting choice to reduce reported profit, okay? And then once again, in the old days, we don't have data to measure political attention, okay? So what do? Once again, we found a very rough proxy for political attention, and this proxy is the size of the firm, okay? So in the old days, in the old papers, you will see the political hypothesis is normally stay in this way, right? Large firms, rather than small firms, are more likely to use accounting choices that reduce reported profits. And why is that? Because the size is a proxy variable for political attention, okay? So reduction of reported profit is hypothesized to reduce the possibility that the people will argue that the organization is exploiting other parties, okay? So once again, research has moved on, okay? So there are lots of more recent research on this topic. They're also interested in the political attention, but now we have a better measure for political attention, okay? We have different database, for example, to measure the median coverage of firms, okay? So you can use median coverage as a proxy for political attention instead of size, because size, as you can see, size is correlated with a lot of things. It's not a very clean measure, okay? But this is a political cost hypothesis. Happy about this? So it's giving managers another incentive to manage the earnings, okay? Now, apart from the three incentives that we just talked about, there are others, right? So I just talking about the assignment with some of you during the break. So the assignment actually asks you to list at least 5 incentives, okay, for earnings management. We've already talked about 3, and I'm giving you another 3 over here, okay? And as I mentioned, there are numerous incentives to manage earnings in the literature, okay? If you want to include those, you are more than welcome to do that, okay? So I think I still have time to talk about these 3 incentives, okay? A little bit. So we've already talked about the second one, the issue and exercise of employee stock options, right? So we talked about this last week. So let me now talk about the first one, the CEO changeovers, okay? Now, what do we mean by CEO changeovers? So CEO changeovers refers to the old CEO retire, okay? And then you have outgoing CEO, and then you have incoming CEO, new CEO. Okay. Now, these 2 different CEOs, they have different incentive to manage earnings in different ways. Okay. So if you are the outgoing CEO, you are about to retire from the company. Okay. You probably will have incentive to manage the earnings upward, right? Because if you manage the earnings upward, you are more likely to increase your retirement plan, right? So because when you are retired, you have to negotiate with the board of directors of your retirement plan, right? So so what will be your compensation plan look like after your retirement? So one of the accounting numbers will be the reported profit. for the recent few years, okay? So for outgoing CEO, you are more likely to manage the earnings upward so that you can negotiate a better deal for your retirement or for your termination. Making sense? Now, if you are a new CEO coming into this company, you'll have different incentive, okay? So very often, if you read the news, right, every time when a company have a new CEO coming in or a new director coming in, what's the first thing they do? They start to blame the previous management, right? So they start to blame the previous management, blame the previous CEO for all these bad investment decisions. So they are more likely to take a big bath in the first few years, right? So how do they take the big bath? They have more negative accruals in the first few years. And why do they do that? Because these accruals is going to reverse in future. They can benefit from the positive accruals in future. Making sense? So this is the motivations, right, for the CEO changeovers, okay? Now, analyst forecasts, okay? So analyst forecasts also puts pressure or give managers incentive to manage earnings. And why is that? Okay, so we talk about analysts a little bit, right, when we talk about the Enron case in tutorials, if you still remember. So for a large company, okay, let's say a BHP, this kind of size, right? So this kind of company, they normally will have 10 or more analysts following them. Okay, so what these analysts do, these analysts collect financial information, collect information from the market, from the industry, and then they come up with their own calculations. So they forecast what will be the reported earnings of this company, okay? So these forecasted reported earnings normally come to the market before the company release their actual reported earnings, okay? So if these 10 analysts comes to a consensus, right? So they all agree the EPS for this company is going to be $10, okay? But as the management of this company, you know your reported earnings will never hit $10. It creates pressure on you, right? Because everyone sets an expectation of $10 for you, but you know you're not going to hit this expectation. Okay? So what do? You are more likely to manage your earnings upward, isn't it? So if you type or you Google Scholar analyst forecast and earnings management, there will be a lot of papers popping up. Okay? So they talk about, you know, the relationship between analyst forecast and earnings management. So basically, in real life, you probably won't see any company that will miss the analyst forecast, okay? So the company want to meet or beat the analyst forecast because they want to meet the expectations set by the market. Because if they don't meet the expectations set by the market will penalize them. How does the market penalize this company for losing the target, losing the expectation? The share price will drop, right? So it has the consequence, okay, for the company to miss the analyst forecast. Therefore, to avoid that from happening, managers, if they know they are going to miss, they will manage the earnings upward. Making sense? Yep. Okay. So we'll talk about these issues in more details in next week tutorials, okay? All right, so now let's have a look at accounting policy choice, okay? So one of the topics today is accounting policy choice. So what we want to talk about accounting policy choice is how does this actually related to earnings management. Our focus is still on earnings management, okay? So I think we talk about this, right, the choices in week 1 and week 2. We said when we have different accounting methods or different accounting policy, it doesn't mean one policy is better than the other, right? So firm choose one policy over another because of incentive is different, okay? So now we're talking about incentive for earnings management. So let's have a look at the incentive behind this accounting policy choice, okay? So what we're saying is the reported earnings, okay, apart from, you actually manage it, you massage it, the reported earnings can also be influenced by the choice of accounting policy, okay? So if we use the PPE as an example, right, we already know there are at least 2 different ways to measure your PPE. You can measure your PPE using fair value. You can measure your PPE using the historical cost, right? And for the depreciation of PPE, there are different ways to do depreciation. You can use straight line. You can use the reducing balance method, okay? So the choice of accounting policy to choose from fair value or historical cost accounting for PPE actually expand the opportunity for earnings management. Does that make sense to you? Okay? So if I have a PPE, if I value it at historical cost, and let's say a computer, when I purchase it, it's $1,000. Okay? Now I can keep using historical cost for my computer. Okay? And I estimate the useful life of this computer is 5 years, so every year I depreciate $200. Yeah? Yeah, $200. Okay? So what if I think the $200 every year for depreciation is too high for me? What can I do? I can either change the cost base of the PPE or I change the useful life of PPE. Yes? So if I want to reduce my depreciation expense for this computer, I can actually decrease the value of computer, or I increase the useful life of the computer. Making sense? Now, if I increase the useful life of computer, then it means I'm still using my discretionary judgment, so I'm managing the accruals, right? I'm using a different judgment, I'm making a different judgment on the useful life, okay? But if I change the cost of the PPE, I said, okay, historical cost is not giving me a good value for PPE. I'd rather revalue this PPE, this computer, to its market value this year, and the market value of the PPE this year is only $800. Okay? So by doing that, I change the value of PPE, therefore I change the value of the depreciation expense every year. Making sense? So by choosing different accounting policies, okay, you are actually expanding the opportunity for earnings management. So another example is like this: when you want to sell your PPE, when you want to dispose it, okay? So if let's say we have this piece of non-current asset, right, with a carrying amount of $100, this is based on historical cost, okay? Now, the selling price is $500, so my customer is willing to pay $500, okay? Therefore, I make a gain of $400, okay? Now, what if I think the $400 gain is too small? I want to make the gain a bit more. How do I do it? I either change the selling price or I change the carrying amount, the cost of the NCA, right? So it's probably will be a bit harder for me to negotiate a higher selling price with my customer, but it's probably easy for me to change the cost of my NCA if I change the valuation, right? So my NCA was valued using historical cost, but now I said the fair value. Now I use fair value to value my NCA, and the fair value for this piece is $80 only, okay? So my selling price is still the same, but my gain increased. Making sense? Yeah? So this is the relationship between policy choice and earnings management, okay? By choosing different accounting policy, you actually expand the opportunities for earnings management. Happy about this? Yeah? Okay. Now, we talk about the accounting policies, we talk about incentive of earnings management. So then let's talk about how do we actually detect earnings management, okay? Now, there's no consensus in practice how you actually detect earnings management, okay? So there's no technical way for you to do that. Because why? Because earnings management is not directly observable. The managers will never tell you, yes, this year we actually manipulate accounts receivable and we manipulate depreciation expense. They will never tell you, okay? So how do you tell this company have earnings management behavior or not? It's very hard to directly observe, okay? But accounting researchers are very clever, okay, in old days. They're still clever now, but in old days, they're very clever, okay? So they come up with this method, okay, to actually proxy for earnings management behavior. Okay, so what they do is they look at accruals. They look inside to accruals because we said when you manage accounting records, when you manage income upwards, downwards, a lot of time you are managing these accruals, right? So what if we look inside to the accruals to see if we can detect earnings management? Okay, so as a substitute, those researchers analyze estimated discretionary accruals. Okay. But there are other ways. But the common way is that we look at the discretionary accruals. We calculate what is these discretionary accruals. Okay? So what is that? So we talked about accruals already, right? So not every accrual is bad. Okay? Some accruals are necessary for the company to survive. Right? So if you look at a firm, right, only have cash transactions, let's say a cleaner. Okay, they provide service and they receive cash immediately. Okay, for cleaner like that, okay, it still have accruals. Why? It may have a vehicle, right? May have a car that allows him or her to travel between different clients to provide the service. So the depreciation on this vehicle is accruals. Now, if you look at this depreciation, you look at these accruals. Is this unpredictable? Is this bad? It's just normal accruals, right? Even everyone sitting here, you probably will have your accruals, right? If you sign a contract with telephone company, you prepay your telephone bills or your internet bills, you have accruals. But do you deliberately manage these accruals? Probably not, right? So what we are saying is not every accrual is bad. It's a result of creative accounting, okay? So for us to detect earnings management, we cannot actually estimate estimate the aggregate effect of accruals from a company's profit, but we need to find a way to separate those normal accrual from those abnormal accrual. Does that make sense? Yeah? Okay. So here is a way of doing that. Okay? So if we look at a company's profit, a company's earning from the income statement, okay, and we look at those transactions that give rise to the company's earnings, we can actually separate those transactions into two big groups, okay? So one group, you have cash transactions. You have your cash sales, you have your cash revenue, and a cash expense. So this happens when you immediately get cash receipts and cash payments, right? When you recognize revenue and expenses. Making sense? So when you pay for a service, you pay cash and you receive service immediately, okay? Or when you sell something to your customer, you get cash immediately. So this refers to your cash transaction, okay? So part of the earnings or the profit that you see on the income statement are cash profit for the period. Does that make sense to you? Yeah? Okay. Now the other part are the accruals. So these are the non-cash transactions, okay? So if you have credit sales, your sales revenue is a credit revenue. It's your accrual, okay? If you have depreciation expense will decrease the profit because it's an expense, but it does not involve cash. Making sense? So from this, okay, you can actually calculate what is a company's total accruals, right? Because you can get the net profit from income statement. You can actually work out what is the total cash flow from your operations, from your cash flow statement. And then the left is your non-cash profit, which is the effect of total accruals. Does that make sense? That's your accrual profit. Yeah? So what are we interested in is what's inside these total accruals. Okay? So what's inside? There are some accruals that are related to the economic fundamentals. So these are the normal accruals. Okay? So for example, when you have PPEs, your depreciation expense is normal accruals. Yeah? When you have credit sales, your accounts receivable and your sales revenue are normal accruals. Okay? So these are the economic fundamentals. They can actually explain why you have made certain profit in that year. Okay? So what's left is these abnormal accruals. Okay, so this is the portion that we are really interested in. This is a portion that cannot be explained by the economic fundamentals. Does that make sense to you? So we have total accruals, right? Part of the accruals can be explained by economic fundamentals, so they are normal accruals, okay? The other part cannot be explained by economic fundamentals, so these are the accruals that is abused by the management. So this is the part that has been managed. Making sense? Yeah? Okay, so this is the basic idea, okay, from one of the early papers on earnings management, on the detection of earnings management, okay? So how do we do it? We use a regression to estimate what is the normal accruals for a company, okay? So you may have learned this on the linear regression from your stats class, okay? So the Y over here is the total accruals, okay? And the X in the middle are the normal accruals. So these are the accruals that can be estimated. These are the expected accruals, okay? What's left, the error term, is something that we cannot explain, and this something that we cannot explain is our discretionary accrual, the abnormal accruals. Does that make sense? Yeah? Okay, I'll give you some time to digest. Okay, so this is the basic idea, okay? Now, I've already talked about this. If we look inside total accruals, we want to separate, okay? Separate the discretionary accrual from the non-discretionary accrual. And this non-discretionary accrual are the portion that is consistent with economic fundamentals of the firm. So for example, a firm with more PPE should have higher depreciation expense. Yeah? So that makes sense, right? So a company with a higher accounts receivable, it should also come with higher allowance for doubtful debt. Yeah? So these are the economic fundamentals, okay? Now the discretionary accruals is a portion that cannot be explained by reference to the economic fundamentals, okay? So this is a part that has been managed. So we use the discretionary accrual as a proxy for earnings management, okay? So step one, we calculate, we need to estimate what is the total accruals, right? As a component of the company's net profit. So from the graph, right, earnings can be obtained from your income statement, cash can be get from your cash flow statement, okay? And the total accruals, okay, therefore can be estimated or can be calculated, okay? And remember what we say earlier, in theory, all accruals will be reversed, right? So all these accruals, in theory, will be reversed to cash in future, okay? But that's just in theory. So step one, we calculate total accruals, which is net profit minus cash flow from operations, okay? Step two, we then want to estimate the expected accruals, okay? So we want to estimate those non-discretionary accruals. And how do we do that? So we know that the accruals should be related to credit sales and collection. It should be related to the level of PPE. Now, once again, the method I'm talking about today is from the research probably 20 or 30 years ago, okay, in the 1990s, I think. So research has moved on in terms of the measurement of discretionary accruals. So these days, as you can imagine, when we talk about accruals, we also talk about intangibles, okay? But the logic is the same, okay? We want to know what is the expected accruals. And in the old days, we have sales, we have credit sales, we have PPEs, okay? So the researchers then start to gather the data on all firms in a particular industry for a given year. So what are they gathering? They're gathering the changes in revenue, their changes in receivables, opening gross PPE, and then the total accruals. So total accruals, we already know it's net profit minus cash flow from operations, right? And the changes in revenue, it's very easy. You get the income statement of one company for 2 years, then you can work out the changes, right? Beginning minus minus the ending balance. Same thing for the accounts receivables and then the opening gross PPE. Okay, so this information can be easily obtained from firm's financial statement. So you get these financial data from all firms in a particular industry group. Okay, now we have to do this industry by industry. Why? Because different industries will have different economic fundamentals. Okay, if you are a retailer, you may have more credit sales revenue, right? You may have more credit sales revenue. If you are a manufacturer, you may have more PPEs, right? If you are financial industry, you are a bank, you may have more financial assets. Okay, so we have to estimate the non-discretionary accruals industry by industry simply because different industries have different accruals, type of accruals. Okay, and then what do? We put everything into the formula that I just showed you, right? So our total accruals is Y, yeah? And then the X, the big X is something in the middle, right? So you have changes in revenue, you have changes in receivable, you have your PPEs, and in this state, in the modified model, you'll have intangibles, you'll have other accruals, okay? So this is the big X. These are the expected non-discretionary accrual. Okay, alpha, you don't need to worry about alpha, this is a constant, okay? So what's left is your discretionary accrual. Making sense? So the discretionary accrual is measured by the error term. So you put the data of all firms in one industry in 1 year into this regression, okay? So what do you want to do? You want to estimate what is the coefficients beta 1 and what is the coefficients beta 2. So what is beta 1 and beta 2? Beta 1 and beta 2 represent the average sensitivity of total accruals to the key economic fundamentals across this industry, Does that make sense? So what we're getting is we put the information of all firms into this regression. So we want to estimate what is the industry average for the total accruals. Okay, to these key economic fundamentals. So the beta 1 and the beta 2 are the expected level of your credit sales and collection, expected level for the PPEs. Making sense? So we have worked out these beta 1 and beta 2, these coefficients, and then we apply this to individual firms. So by putting in the individual firm's own financial data into the regression, okay, into the calculation. So if we assume beta 1 is 0.1, beta 2 is negative 0.07, okay, and this particular firm X has change in receivable minus changes in revenue minus change in receivable 100,000, and the PPE of 1 million, okay, so the expected accruals for firm X should be minus 60,000. Does that make sense? So this is what we expect firm X non-discretionary accrual. Making sense? So we estimate the industry average. Okay, so this is what an average firm in this industry should have. And then we multiply by the credit sales of firm X and the PPEs of firm X. So we can work out what is the expected normal accruals for this particular firm. Okay? And then remember, we know what is the total accruals of this firm from income statement and cash flow statement, right? So if the firm's actual accrual, total accrual is negative 20,000, and the expected normal accrual is negative 40,000, therefore the discretionary, the error term, is a positive 40,000. So what does that mean? That means the negative 20,000 actual total accrual of firm X, okay, within that, negative 60,000 is explainable. So you can actually explain why you have 60,000 accruals, right? Because within your total accruals, because these are related to your economic fundamentals. Okay, so what's the difference? The difference is something that cannot be explained by the economic fundamentals, and this is your discretionary accrual. Making sense? Yeah? Okay. So now, we have positive 40,000, okay? So what we can say is that firm X have positive or income increasing discretionary accruals. So this may indicate that the firm has been manipulating earnings upward. Does that make sense to you? Yeah? Okay. All right. Now, once again, we may have alternative explanations, okay, even though we see a positive 40,000 discretionary accrual, okay? So what are these alternative explanations? First of all, when we look at this particular firm, right, firm X, okay, firm X may have some special characteristics that does not apply to other firms within the same industry, okay? So for example, firm X might own in very different PPE to other firms in the industry. Therefore, the PPE here, even though you estimate industry average, but firm X will have a very different structure of PPE over here, therefore influencing the calculation, okay? Or firm X have a very different credit terms to others, therefore the changes in revenue and the changes in collections are different, okay? Or firm X have different accounting policies, right, to value their assets. So they use fair value accounting, while the most other companies using historical cost, okay? Or there are unsystematic shock to X performance, okay? So we talk about unsystematic shock or unsystematic risk last week. So these are the shocks special or inherent to this firm. So the shock only applies to this firm's performance, but it's not an industry-wide shock. So it does not apply to all other firms in the industry, it only applies to firm X. Okay? So all of these may explain why firm X have a positive 40,000 discretionary accrual. Okay? So guess what? As researchers, we then have to do more tests to rule out this explanation one by one. Okay? If we want to say this 40,000 discretionary accrual is an indicator of earnings management. Before we can say that, we have to rule out all these alternative explanations. Okay? So, when we look at this discretionary accrual we just calculated, okay, we cannot directly say it's an indicator of earnings management. Okay, it's only an indicator of earnings management when the magnitude of this discretionary accrual is significant, is material. Okay, so when discretionary accruals are significantly different from zero, it then may indicate earnings management, okay, when we rule out other explanations, okay? So when you see a significant negative accruals, it may indicate the managers have used the discretion to reduce the current income, but when you see a significant positive accruals, that may indicate the managers have used the discretion to increase the current income, okay? Now, what we just discussed is the accrual-based earnings management, okay? But remember, we said there's another type, which is called real earnings management. So real earnings management refers to those when the managers manage the real timing of the transaction, right? So they alter the timing of the transaction, okay? So the business, as we say here, can always manipulate earnings by adjusting the timing of the real transaction so that the income is recognized earlier or later that would otherwise have been the case. Okay, so there are questions in your tutorials about the real earnings management. So the way that we do it is different, but the motivation is the same. Okay? All right, so here are just some empirical evidence, okay, with regard the three hypotheses that we just talked about and other hypotheses that we mentioned, okay? So these are the findings from the prescribed readings, okay, for this week. So for example, firms with greater level of debt are more likely to engage in income increasing assets, asset sales. So we are talking about the debt hypothesis, right, in the first paper. The second paper, firms subject to regulatory investigations are more likely to manage earnings downward. So we are talking about the political cost hypothesis. New CEOs are more likely to manage earnings downward in the initial year of their tenure, and then manage earnings upward in the later years. So we are talking about the CEO changeovers. Okay. So I guess the question that you probably need to think about is what factors, okay, what logic might explain these results, which we have already discussed. Okay. All right. So we finish earnings management. Okay. And next week we're going to talk about capital market research. All right? So if you don't have other questions, that's all for today. And then I look forward to see you next week. It's up to you. Okay. So as long as your part one meets, your summary meets all the requirements, then it doesn't matter whether you put the reference together or separate.
Okay.